Welcome back to the Deep Dive. We're your hosts from TalkTickers, here to break down the latest earnings calls for you.
That's right. Today, we're tackling Southern Missouri Bancorp, or SMBC. We've gone through their Q4 Fiscal 2025 call.
And our mission, as always, is to sift through it all, pull out the key takeaways, and give you the insights you need, especially if you're an experienced investor following the space.
Let's get right into it.
Okay, so let's kick off with the headline numbers, the ones that really caught the eye immediately.
Yeah, SMBC reported a pretty strong fourth quarter.
Their GAAP EPS came in at $1.39.9. That handily beat the consensus estimate, which was $1.26.
Right. And revenue looked good, too. If you combine the net interest income and the non-interest income, that total was $47.61 million.
Also beating expectations there, the consensus was around $46.26 million. So a solid beat on both lines.
Definitely. And you saw the market reaction, right? Pretty positive on the day of the call, reflecting that solid beat.
So what were the underlying metrics driving that?
Well, a few key things. The net interest margin, or NM, it expanded to 3.46%. Return on assets, ROA, was 1.27%.
Okay.
And return on equity, ROE, hit 11.8%. But what really stood out to me was the tangible book value per share growth.
Oh, yeah. How did that look?
Impressive, up 14% year over year, landing at $41.87.
Oh, wow, 14%.
Yeah, and that strength directly supported an 8.7% hike in the quarterly dividend. It's now up to $0.25 per share. That's, a clear signal about creating shareholder value.
And it wasn't just a strong quarter closing out the year. The full fiscal 2025 looked good, too.
It did. Diluted EPS for the full year was $5.18. That's up quite a bit from $4.42 in fiscal 2024. Real momentum there.
Okay, so let's unpack these numbers a bit. What were the real drivers behind this performance, and what's management signaling for the future?
Well, the net interest margin expansion to 3.46% was definitely a highlight.
How do they manage that?
It wasn't just luck. It was largely driven by getting better yields on their loans and also strategically moving some lower yielding cash balances into higher yielding loans. Smart deployment.
Makes sense.
Plus, management noted that funding costs are actually easing up. That's allowing them to be, let's say, less aggressive with their CD specials.
Because the competition locally has calmed down.
Exactly. More reasonable, as they put it, which, could give them an edge over some peers maybe still struggling with those sticky funding costs.
Now, something really interesting on the NIM front caught my ear. They're planning to change how they report their quarterly NIM starting next fiscal year, right? Fiscal 26.
That's right. They're moving to an annualized day count basis.
Why is that significant? Why should investors pay attention to that change?
It's actually pretty important. This change should reduce some of that quarter-to-quarter volatility you sometimes see in reported NIM. It'll make the comparisons, period over period, much clearer, more consistent.
Okay, so cleaner comparisons.
Yeah. And you couple that with the fact that their loan portfolio is repricing upwards, at current, generally higher market rates. Management sounds pretty optimistic about further margin expansion in FY26.
Do they give specifics on the repricing?
They did. They highlighted that new loans they're originating are averaging around 7.3%. Meanwhile, the loans maturing over the next 12 months are averaging about 6.3%.
So a positive spread there.
A full percentage point difference, yeah. That positions them really well, especially, if the Fed does eventually cut rates later this year, their deposit strategy gives them room to potentially lower funding costs, too.
Okay, shifting gears a bit, let's talk loan growth. Where's the capital actually going?
They saw pretty robust activity in Q4. Gross loan balances were up by $76.2 million.
Which translates to?
An annualized growth rate of 7.6%. Pretty strong.
And what kinds of loans were driving that? Any particular areas?
It was fairly broad-based, actually, driven by commercial and industrial C&I loans, multifamily housing, and also agricultural production loans.
Across their footprint.
Yeah, they saw solid contributions across their southwest and east regions. So it suggests healthy, kind of diversified demand.
So looking ahead into fiscal 26, can we expect that same kind of momentum to continue?
Well, management's targeting mid-single-digit loan growth for the full year, so maybe a bit more moderate than that 7.6% annualized Q4 rate.
Okay.
And they did flag something specific for Q1. They anticipate higher than usual prepayment activity.
Oh, in what area?
Particularly in non-owner occupied commercial real estate. So that could kind of temper the net growth in the very near term, the first quarter.
But the underlying demand is still there.
Seems like it. You have to balance that prepayment warning with their loan pipeline for the next 90 days. It's strong, sitting at $224 million.
And how does that compare?
That's up quite a bit from $163 million in the prior quarter. So yeah, the underlying demand definitely looks solid.
Okay, but it wasn't all completely smooth sailing. The provision for credit losses, the PCL, that went up.
It did. Rose to $2.5 million in Q4. That's up about $1.6 million from Q3.
So while the headline numbers are strong, does that increase in the provision mean investors should be maybe a bit more cautious about credit quality?
It's a fair question. And yes, credit quality has shown, let's say, some deterioration from the, frankly, very low levels we saw in recent years.
But still relatively strong overall.
I'd say so, yes. Non-performing loans did increase to $23 million. That's about 0.56% of gross loans.
What drove that increase? Anything specific?
A key factor they mentioned was a specific $5.7 million construction loan. It was for a senior living facility.
Oh, okay.
And importantly, it was a loan they acquired through the Citizens merger. That specific loan was placed on non-accrual status.
So maybe more of an isolated acquired issue rather than a systemic trend in their own originations.
That seems to be the implication, yes. Context is important there.
And what about that special purpose commercial real estate or CRE issue that they flagged previously? Any update there?
Yeah, they addressed that. They confirmed they took a $3.8 million charge-off on one of the loans within that specific relationship.
Okay, so charge-off taken.
Right. Which reduced the outstanding balance on that loan to $6.2 million. But what's really revealing, I think, is what they said next.
Go on.
The remaining balance on that specific loan still has about 45% in specific reserves set against it. And management explicitly said, quote, it wouldn't surprise them if there were additional charge-offs on the other remaining building in that relationship.
Wow, okay, so very transparent about potential future losses there.
Exactly. It suggests they're being cautious and upfront about this known issue. Now, the overall allowance for credit losses, the ACL, it did decrease because of these net charge-offs.
But offset somewhat?
Partially offset, yeah. Offset by higher model-driven losses, which reflects management's updated, maybe slightly more cautious view on the economic outlook.
So the takeaway for the provision going forward?
We should probably expect, a bit of an uptick in the normal quarterly provision level, just given the current economic backdrop and these asset quality trends, something investors should definitely keep an eye on.
Let's pivot to agriculture. That's obviously significant for a bank based in Southern Missouri. What are the trends there?
Yeah, it's a key segment, and it is facing some prolonged weakness right now.
What are the main pressures?
Farmers are really battling a combination of rising input costs and lower commodity prices, especially for key crops like corn and soybeans.
So profitability is squeezed.
Very squeezed. Management said farmers are largely pessimistic about profitability for 2025 and even looking out with concern towards 2026.
How does that show up in banking terms?
Well, it's leading to heavier draws on lines of credit, and in some cases, unfortunately, farmers are voluntarily choosing to wind down their operations.
So how is SMBC managing that risk?
They're being proactive, monitoring crop progress very closely using Farm Service Agency, or FSA, guarantee programs where possible that helps de-risk things for the bank.
Okay.
They're also restructuring loans when it makes sense, and importantly, increasing reserves specifically for borrowers on their watch list in that ag sector.
Any potential bright spots?
They did mention the potential for federal aid under a recently passed bill as maybe a supportive factor down the line. But yeah, it's definitely a challenging environment for ag right now.
Okay, let's talk funding. Deposits increased by $20 million in the quarter, but management called it a seasonally slower period. What's the strategy on deposits going forward?
Well, the interesting thing is they expect less reliance on CDs, certificates of deposit, in fiscal year 2026.
Oh, really? Why is that?
They feel their funding position is strong enough that they can be, and I quote, a little less aggressive on the CD side.
Because that local competition eased up, as you mentioned earlier?
Exactly. And just to put numbers on it, the average CD rates that are rolling off soon are around 4.24%.
And the replacements?
Currently coming in around 4%. So that suggests their funding costs could continue to stabilize, maybe even improve slightly.
Just a quick note on the operations side. Non-interest income got a nice bump, right?
It did, yeah. Up 9.2% quarter over quarter, mostly thanks to a one-time card network bonus they received.
But there was an expense offsetting that somewhat.
Yeah, a $425,000 consulting expense. That was related to negotiating a new debit card network contract. So kind of an investment there. And one more thing, a crucial accounting detail investors should be aware of. SMBC adopted a new standard, ASU 2023-02.
Okay, accounting standard update. What does it do?
It affects how they account for renewable energy tax credits. These benefits, which were about $700,000 for fiscal 2025, are now accounted for as a direct reduction to income taxes
Instead
of potentially reducing fee income like under previous guidance. So for you as an investor, the bottom line benefit is the same, but you'll just see it show up in a different place on the income statement. It's a reclassification, not a loss of value.
Good clarification. Thanks. So let's try and connect all these dots. We've got the earnings beat, the needs expansion, decent loan growth, but also rising provisions, challenges in ag. What does this all mean for SMBC's position compared to its peers?
Well, SMBC has clearly demonstrated pretty strong performance relative to other regional banks. If you just look at total return over the past month leading up to this call, SMBC was up about 6.8%.
And the comparison?
The KRE, the main regional bank ETF, was only up about 1.1% in that same period. So significant outperformance.
And that's not just a recent blip.
No, that outperformance extends over longer periods too. It really reflects, I think, solid execution by the bank over time.
That is impressive. But some might argue, smaller regional banks can carry higher specific risks. How does SMBC's consistency square with that?
That's a critical point. I think for SMBC, it comes down to their strategic focus, that strong, tangible book value growth we talked about, their proactive management of both sides of the balance sheet, loan yields and funding costs.
They're not just riding the wave.
Exactly. They seem to be actively managing their levers. Now, the broader environment for regionals has been getting better, more constructive. Deposit competition is moderating. Things are stabilizing. That definitely helps provide a supportive backdrop.
So market sentiment towards SMBC specifically?
I describe it as cautiously bullish, the clean beat on EPS and revenue, the improving NIM, that solid TBV growth. Those are all clear positives. Tempered somewhat by that higher provision for credit losses, though, as we discussed, a lot of that seems tied to that one specific, largely isolated CRE issue, not necessarily a sign of widespread weakness. And something else that really stood out in the call was management's discussion around capital allocation, specifically M&A.
Oh, yeah? What did they say?
They noted a, quote, modest uptick in M&A discussions. And they highlighted a pretty broad landscape of potential partners, particularly focusing on Missouri and Arkansas.
They give numbers.
Yeah, they mentioned roughly 50 banks in Missouri and about 24 in Arkansas that fall within their target asset size, which is between $500 million and $2 billion.
Okay, so M&A is clearly on the radar. How are they thinking about that versus, say, buying back their own stock?
This was really interesting. They explicitly stated they are prioritizing M&A opportunities if those deals offer a shorter tangible book value earn back period compared to repurchasing their own shares at current prices.
So a very disciplined approach. They're looking for value.
Exactly. It's not just growth for growth's sake. It signals they see potentially significant, maybe undervalued opportunities for external growth right there in their regional footprint. Could really reshape things in Missouri and Arkansas if they pull something off.
All right. So for those of you really digging into SMBC strategy, that whole capital allocation discussion, particularly the M&A focus, it kind of sparks a conceptual trade idea. Maybe a bit aggressive, but plausible.
And let's stress again, this is purely an exploration of a market strategy. Definitely not financial advice.
Absolutely not financial advice, just thinking out loud here. But you have management openly talking M&A, right? Targeting specific states, specific asset sizes.
And explicitly comparing the earn back on deals versus buybacks.
Yes. Saying a deal could have a shorter earn back. That feels like more than just casual talk. It's almost like they're laying out a strategic roadmap.
Okay, so how would someone purely conceptually try to capitalize on that stated intent? What's the wild idea?
Here it is. Maybe a long position in SMBC itself, banking on their execution and potential accretion from a deal, paired with, wait for it, a short straddle on a carefully selected basket of potential targets.
A short straddle, selling both a call and a put on the potential targets.
Exactly. On a subset of those banks in Missouri and Arkansas within that $500 million to $2 billion range. Let's call it the show me the deal basket.
Okay. Walk through the rationale there. That sounds complex.
The thinking is you're long SMBC because you believe they'll acquire well and the deal will be accretive, driving their stock up. Simultaneously, you sell the straddle on the likely targets.
Betting on low volatility in the target stock, or perhaps profiting if the deal announcement itself crushes implied volatility.
Kind of. If an acquisition happens, and maybe the premium paid isn't seen as astronomical, the target stock might not jump dramatically. Or there could even be some short-term volatility or a slight dip. That scenario could potentially make the short straddle profitable, especially if volatility collapses post-announcement.
So you'd need to pick targets carefully.
Absolutely. Ideally, fundamentally sound banks, but maybe ones with lower liquidity or less analyst coverage. That maximizes the surprise factor if an M&A announcement drops.
So you're trying to capture SMBC's core growth plus an M&A kicker, while the short straddle acts as a kind of hedge against maybe overpaying or market jitters around the target.
That's the concept. It's about anticipating the M&A playbook that management seems to be telegraphing. Again, highly speculative, not advice, just an interesting thought exercise based on their commentary. Okay, so let's wrap this up. In summary, Southern Missouri Bancorp put up a strong Q4. Beat on earnings, beat on revenue, saw that net interest margin improve, and delivered really significant tangible book value growth. Strong execution.
Definitely. Although credit costs were up, driven mainly by that specific commercial real estate issue we discussed. But management seems proactive, they're transparent about it, and the overall outlook for fiscal 26 sounds pretty constructive.
Especially with that disciplined, strategic approach to potential M&A adding another layer.
Exactly. Lots of positive momentum, even with the known headwinds like agriculture and watching credit.
And just a final reminder, everything we discussed here on the deep dive is for informational purposes only. It should not be considered financial advice.
Please, always do your own research, conduct your own due diligence, and consult with a qualified financial advisor before making any investment decisions.
We really hope this deep dive into Southern Missouri Bancorp's latest earnings call has given you some valuable insights.
We appreciate you tuning in. Feel free to send us your thoughts.
We'll be back in 3 months for the next quarter's breakdown. Until then, maybe ponder this. What do you think SMBC's next big strategic move will actually be? An acquisition like they hinted, or something else entirely? We'd love to hear what you think.